were the beneficiaries when they took out their loans or collateral of the proceeds of crime, which then would be the unsecured creditors in FTX.com, which would be more retail. So I think this is going to be hedge funds versus retail. And I think we need to ensure that the depositors and creditors at the FTX.com side are the ones that win the argument. And I think, not a lawyer, but I think the proceeds of crime would be the defense there.
Richard, I think
I'm more
right.
concerned.
That's going to take a while.
I'm more concerned with so if you resolve all of these bankruptcies and you distribute what's left amongst the creditors, they're not guaranteed to sell. It's not 100% sell. But we've got some other big coin amounts out there that I'm pretty sure are 100% sell. So when the Department of Justice seized $1 billion worth of Bitcoin from the Silk Road hacker last week, that's a sell. They're going to sell that. They're not going to sit on that. That's a guaranteed sell. So I don't know how many billions, and then I don't know whether they're going to give the Finex hackers, the other Finex hacker, the Silk Road hacker was the one earlier this week. The Finex hacker was maybe 6 months ago, and they got, I don't know, 100,000 coins? I don't even remember what the number was.
Yeah,
so
it was
a couple billion.
119,000 Bitcoin, and then I think there was only probably 100,000 or something retrieved.
Yeah, so there's
the Mt. Gox
150K.
one was 200,000 Bitcoin of 800 because Mark Capellas found a private key under his mattress.
Yeah, I think Gox has got 140 left, 140K, and then you told me that Finex is at 100, and then this guy they just got was like 52K. So that's like what, 270 or something?
Yeah, and then Celsius essentially invested all the Bitcoin in a Bitcoin mining operation, and then they're left with about 30% of it, and a bunch of it was in WBTC, which interestingly they sent over to FTX, which may be subject to a preference. Because I think they tried to get the WBTC into BTC. I got to remind myself of that. It was quite a while ago.
Right.
And then there's the Voyager ones as well.
I'm trying to figure out how much actual market sells are going to happen. So all these bankruptcies, those aren't market sells. But the DOJ is going to be a market sell, or an auction at least.
Yeah, so the Silk Road ones were auctioned off to VCs. The Japanese civil rehabilitation, they did actually market sell and cause a crash, which was just dumb. They got rid of all the Bitcoin Cash because that happened halfway through they only got rid of some of it. They're still sitting really?
on. They sold equal amounts to the BTC and the BCH.
Yeah.
So they're still sitting on 120,000 BCH as well.
Yeah. So Richard, unfortunately, we do have these centralizing effects. So in the case of the Bitfinex hack recovery, those Bitcoins are actually the property of those that had the recovery right token, which was part of the recovery plan we did in 2016.
I know that everyone wants that to be the case, but I heard the DOJ is trying to just jack them. I heard they've been filing paperwork to just steal them for themselves.
Well, there you go. There's a case there, but then it's also the Leo token holders, which was as a result of the Tether crypto capital hole.
Yeah.
So those are, I guess, entitled to them by, let's say, token promise or smart contract, but then there's a legal process because the DOJ actually has them.
Yeah.
And then all of these. So the big when everyone's doing their technical analysis right now, unfortunately you can't ignore the fundamentals. That there's these big pockets, and if it goes into Chapter 7 liquidation, my belief is that it would probably be, well, it depends. If they want to be a bad actor, the DOJ could do a market sale. If they want to be a good actor, depends how many people.
Depends how many U.S. Marshal auction.
Yeah, it depends how many people in the DOJ own Bitcoin. Then they might do an auction. But if it goes into Chapter 11, then you can get a payment in kind, plus an auction process. So where securities could also be issued, because there's exemptions in the bankruptcy code, where rather than having to be a public company and be limited to the Jobs Act, which is 2,000 investors, you could actually issue these shares, which is what we're fighting for in the in the Celsius case at the moment, because essentially Alex just went out and played VC, invested in a bunch of private equity mining companies, self-custody companies, and
he
we
did
want to
some
make sure
FOMO
that that's
tarding
going
as well.
through. Yeah.
He did
So
straight up
the interesting thing,
degen
if we get
gambling.
this outcome right, we could end up with a really. So think about this. So you've got at the moment you've got the VCs, but if the retail win these cases and we get to distribute all of these shares and assets to 5 million people, we could end up redistributing and decentralizing the equity in many of these companies. That might be a really interesting turn of events.
I got a good one for you. Here's a fun thought experiment. GPTC is like half off of spot BTC. Ready for this one? Roll up the trust, liquidate it, and sell all the coins. I think they've got 350,000 Bitcoin, 320,000, something like that.
They had 100 million.
Yeah, no, GBTC. I'd be again. Nothing surprises me now, but I'm pretty sure that was operating fully segregated, and it wouldn't be mixed in with if you had a segregated crypto lending company. I don't think you could come after the
like,
backing of a trust.
Look at
a trust structure. So
yeah, but look at the math this way. Okay, right now the market price for your entire GPTC enterprise is worth literally half of its assets. So in a I don't know whether leveraged buyout is the right word or whether hostile takeover is the right word, but anyone could arbitrage that difference by giving them a 20% bonus on what the market's currently giving them. So like this is what Elon did with Twitter. So you offer the GBTC guys a 20% bonus over what the market is currently offering, which is half off of their book value. And then you give them the money, you get the coins, and then you dump the coins on market and make the difference.
yes,
It seems like straight up normal economics.
Yeah, if any of those go into the Chapter 11 process, you could use the auction to do a community LBO and execute something like that. These are all the. I know that we're thinking about tragedy right now, but the free market solutions that can come from this, rather than having the government bailout, I think there's a lot of that's definitely an interesting idea that in theory could actually happen.
Well, I want to know what the likelihood is of their coins dumping. Like so basically normal Bitcoin cycle, 85% dump. No one ever believes it when it comes, but it comes every 4 years. And now I'm just wondering how much extra downside there might be above and beyond 85 due to this hidden leverage, hidden FOMO tards getting liquidated, the cost of the dollar going up for once in 20 years, things like that.
It's basically from here, it's an industry lobbying effort. The institution is going to be, if all of these companies go into Chapter 11, then you essentially have Chapter 11 is a protection process to protect them from lawsuits. And then you have the DOJ that engages the US trustee. And the US trustee, if they think there's too much criminality or it's not moving in the right direction, then they can compulsory take over. That's very rare that would happen. But essentially, the end decision of this is the investment banks that these companies engage in order to go through the bidding process, who ends up buying those companies, and whether we can actually distribute the assets to creditors rather than a predator coming along and buying up the whole industry, or the US trustee just saying, right, we want to have a big systemic effect on this industry, which would be harmful to creditors, and then they could take it into Chapter 7 and try and liquidate, market, sell. Those are threats to the short term.
Simon
pricing.
and Richard, I have a big question because I think this is important also. I mean, there's two things here. The first one is, ideally, what you would like to see is everybody pulling out of all of the exchanges just to stress test them and shit test them. And then those who are still alive mean that they already are working okay. And then learn the lesson of history saying, okay, I'm going to treat the market like a whore in and out when I want to trade, but my big treasury, I'll keep it on my keys. It's my keys, so I keep it outside. Ideally, that's the way I see things.
I think you permanently replace all the centralized crap with DeFi.
Yeah,
You can bridge
sure,
Bitcoin to
but
Ethereum.
here's the point that I'm trying to make. Is like there's 2 points here. The first one is if you do that, you know, and then you do that on the traditional market, then it would be a catastrophe. Whereas in the crypto market, you could still survive theoretically, you know. So that's the big risk I think the regulators are looking at, because if people are saying, okay, pull your money out of the exchange, but then by the same token, pun intended, you should also pull your money out of the banks, then everybody's toast, right? So
Hey, Kim, can I just make one point there? So the reason why I don't think this is a good idea to be promoting is because
that's the thing. Just let me finish. The thing is that the problem with that also, and why it's not a good idea, is because if you start removing the liquidity from the pools, if you start removing the liquidity from those staking things, you will know that subsequently you will have another token drop, because those pools have tokens as well. Let's imagine everybody pulls their money out of Uniswaps or the pools. The Uni tokens are going to tank, and then people are going to lose a lot of money, and then it will just unfold a domino effect onto the entire bloody ecosystem. So
That's not how it
I don't know
works.
if that's what you wanted
The
to
Uni
say,
token
but
has no relationship to actual Uni trading. It was a duct taped on crap coin that has no relation to the actual project at all. The Uni
yeah, but
token
like I
is
mean, when you get the yield from the transactions, obviously, if you don't,
yeah, but the yield goes up the less people that are participating in the pool. So it's self-balancing. So the less people are competing you as liquidity providers, the higher yield that you'll earn, because you'll be sharing the fees across a smaller pool of people. What you have to understand is
Are
that
you just
exchanges
slowly
serve
explaining
very
a
few.
swap to him? Is that what just happened in slow motion? You just explained a swap to him?
No, I'm explaining that
it's the yield from the protocol as well, though.
Liquidity providers split the revenue of swaps in a pair, and they split it by their portion of total LP. And it's more advanced in Uniswap v3, where you can choose to participate in certain ranges and not other ranges. Uniswap v2 did not offer that. You had to provide full liquidity across all ranges, whereas Uniswap v3 is theoretically more capital efficient because you can centralize it in more reasonable ranges and not have to provide liquidity in the middle of nowhere where everyone touches it. So what I'm saying is an idea like everyone pull their LP from Uniswap isn't as compelling as you might think, because it would counterbalance your effort to defund the LP with increased yield, because the fees are 0.3%. Well, you can choose, but they're usually 0.3%, unless you're on a stablecoin pair, which is 0.1%. So on those 0.3% pairs, if there's $100 million of volume a day, the fees per day is $100 million times 0.3%, and that gets spread across the LPs in that range. And so if you try to get people to pull their LP, it's going to...
Thanks for